Hello again, everyone. I'm Valerie Leonard, founder of EverThrive Financial. You might be wondering how your money and investments may be affected by all the things happening in the world around us. So let's jump right in and look at 5 things investors need to know in May as we head into the summer. Today, we'll talk about volatility that we're expecting in the months of June and July, as well as where we are today, 3 G's you should know about right now, potential tariff impacts on businesses and consumers, and some key investor perspectives. One of my goals with these market update videos is to cut through all of the noise so that you have a clear, reliable, and unbiased picture of what's happening in the markets and the economy. While there are a lot of narratives out there, you should know that the US economy remains stable based off of all the data that I watch closely. We'll look at some of the data more here in just a minute, but the frame portion of the chart in front of you here shows recent S&P 500 performance. There have been some big market movements, and I do foresee markets continuing to be volatile in the months of June and July. Note that the red, blue, and green lines on this chart can potentially help us identify trends. The red line represents the 200-week moving average, which can be seen as a potential floor in the market, and levels hit near the red line in early April, and then we bounce from there, which is a normal and a healthy sign. While it wouldn't be out of the question to retest those lows in the coming months, and again, even a retest could be seen as somewhat normal, the fact that we bounced off of that red line and moved back to levels of late 2024 and January of this year is a healthy sign. At this point, we are just watching closely to see if any cracks show up or if there is enough upward momentum to push us to higher levels. This is where it becomes ultra important to keep an open mind to both better than expected potential outcomes in the market and also at the same time worse than expected potential outcomes. None of us, of course, have a crystal ball, but from what I currently see in the data that's available as of the recording of this video, which is Thursday, May 15th, we could be well on our way to a stronger fourth quarter once we get past the summer months. That brings us to a quick look at sector performance so far this year and over the past year. You can see that we are seeing negative performance in energy and materials in the trailing 12-month performance column, but that's to be expected given everything we have going on. While all of the other sectors shown here have performed well over the past 6 months. On this slide, you'll see that materials have been negative over the course of the past year, while technology has struggled more so over the past 6 months. One of the better performing sectors has been utilities as well as consumer staples over the past 6 months, but the trends overall are still largely positive across the board. The second thing investors need to know this month involves 3 Gs. First of all, gold, which has been a great hedge against the falling US dollar. We expect gold to potentially continue to rise as long as the US dollar falls. Second, GDP is slowing, of course, and this has caused some concern. But still, we don't see a recession on the horizon at this point. The bond market is one of the most important potential indicators of upcoming recessions. And right now, the bond market signals do not point to one. And for the last G, consumer goods are creating some distortion in GDP levels and imports because of short-term trends. We've seen people rush out to buy certain things here in our economy and import them before the tariffs hit. So specifically, biggest imports that we've seen recently have been consumer goods, pharmaceuticals, and gold bars. So this short-term trend obviously can distort the data and affect GDP numbers. Next, based off of tariff actions, shipments from China have essentially stopped. That's probably no news to you. So keep in mind that roughly 70% of what's sold in Walmart is made in China. And logistically, it takes about 2 to 6 weeks for cargo shipments to make it to the United States from China, depending on which coast you're docking on. And this means that shipments impacted by tariffs are just now starting to arrive here in the US in the month of May. So we're likely to see some short-term dislocation in the supply chain. This is compounded by the fact that retailers were ordering more inventory in anticipation of tariffs. So even with tariff resolution, there is about a 6 to 12 week gap in shipping. The 90-day pause in Chinese tariffs means that the Fed may delay rate cuts, which they're trying to avoid despite pressure from the White House. Tariffs have changed behaviors for all parties, and it's made it difficult for the Fed to know how to react. And typically, the Fed looks backward to make their decisions based off of past data, But of course, President Trump has been urging them to try and look forward, given his agenda to preempt any pain that tariffs may cause. Small businesses are feeling some of this pain. Many have seen their costs double, some have seen their costs triple. And since manufacturers have to pay higher costs today, business owners are concerned with making it through 6 months of sales, manufacturing, shipment, and collection cycles. Also, consumer confidence has dropped as a result of tariff news as well. But still, employment remains strong, and the service sector is still in expansion territory, and service sector confidence also remains strong. Lastly, this month, I want to remind you that smart investing is not just about external actions, it's also about your internal mindset. And you've heard me say many times that patience is important and keeping an eye on the long term trend is key. Right now, our economy is resilient, and we advise our clients and investors in general to keep a mindset of internal resilience as well. If markets remain choppy over the summer, we generally believe the best course of action is to keep a long term perspective. Of course, every investor is different, and your own circumstances and risk tolerance must be taken into consideration before making investment decisions. So, if you have any questions about what investment strategy might be right for you, don't hesitate to reach out to us. We appreciate you joining us today and look forward to seeing you back here on our YouTube channel soon. Don't forget to hit the subscribe button. We'll continue to post videos as conditions change, and we hope that you'll reach out when you have questions or when you need help managing your investments.